Good afternoon. It's Jeff Christian, CPM Group. It's about 12:20 on Friday, the 21st of April here in New York. Gold's trading around 2002 right as we speak, having dropped as low as 1992 earlier in the morning. Silver is around 25.33. It also had fallen earlier in the day, but they both continue to be in recent ranges. I want to talk about record silver prices, and I want to put some perspective to what record silver prices mean. Now, CPM Group has been speaking about our expectation that silver prices would rise to record levels over the next few years, and we've been saying that for several years, probably a decade or so, that we thought that the price of silver and the price of gold would reach record levels, new record levels, probably around 2024, 2026 in that area. And I want to talk about what we mean by that. And I want to talk about the nature of record prices, and the nature of spikes in prices and the differences between spikes in prices and annual or quarterly or ongoing average prices. Because there's a big difference there. And I'm not quite sure that people really stop to think about that. So then I'll talk about where we think the market is right now. I'll give you a little current market update. And talk about CPM Group's expectation for gold and silver prices over the next week or two and the next few months. And you hear people still talk about how silver is going to rise to $50. And then there are other people who talk about $100 or $5,000 silver or whatever, but let's just stay on the 50. A lot of people talk about it, and in fact, I looking at YouTube earlier this week, and there were people saying silver's got to go to $50, or the real or the natural price for silver is $50. And why do people pick $50 as a target? Reality is there's no rational reason. We'll talk about the fact that the price of silver has spiked close to $50 twice in history and what that actually means. But 50 is just a number. And when they talk about silver rising to $50, are they talking about silver rising to a spike of $50, spiking higher on an intraday basis the way it did in 1980 and 2011? Or are they saying that silver is going to rise to $50 and stay there? And again, there's no rationality behind any of this stuff. And there's no discussion about the economics of mine supply and secondary recovery and fabrication demand and investment demand and changes in inventories that a price of $50 or any other high price would bring. Probably because the people who think that silver is going to go to $50 have no real understanding of the economics of mine production or secondary recovery or fabrication demand or investment demand or inventory changes. It's just a number that they've picked out. And then those projections of $100 and higher, you can just completely ignore those. Those are totally unrealistic and hyperbolic. There's no reality behind them. So I want to look at 3 periods of time. This is the current period of time. I have here the intraday, the daily prices, high-low settlement on COMEX, nearby active prices since January of 2022. You can see the price rose sharply as we moved toward the Russian invasion of Ukraine and the Russians invaded Ukraine. It got up to about $27 and some odd cents. It came down into September. I think the low was in September last year. Kind of moved sideways into November, started to rise November, December, January, and kind of plateaued January, came down in February, and rose in March. This is where we are today. Again, as I said, the price is around $25.33 right now. It had gotten up a little over $26 in March due to concerns about banking industry stability. And here on the right-hand side are the actual quarterly and annual average prices. So you can see, first quarter of last year, $24 average. Came down progressively into the third quarter, $19, back up to $21 in the fourth quarter, and $21.80, so 50 cents higher than it was in the fourth quarter on an annual average basis. And then a little bit higher to $22.64 in the first quarter. So there's that. But let's compare this to what's really important. Real life silver prices in 1979, 1980. And you can see on an intraday basis, the price spiked up there. It got to $49.65, I think was the high. It was 49 something. Didn't quite touch $50 on an intraday basis. It was there for about a minute. And at the end of that day, in January of 1980, the price settled at $41. So if you think about it as that intraday spike to the intraday's close of business, the price had gone from 49 something to 41 something, off $8 off of $49. It's a pretty steep drop already. Yeah, 10%, 20%, 18%. And you can see here, I took this chart back to January 1979, and that's a personal date for me because in January of 1979, I was writing about electric vehicles and energy markets and copper, and I took over a section writing about precious metals. And I took over that section. Silver was a little over $5. Gold was, I think, probably around 100 and something. It was between $100 and $200. And no one wanted to write about precious metals in January of 1979. They were dead markets. They were not interesting markets. So I took over the precious metals writing assignments and studying them. And as you can see, the price moved sideways into about September of 79. It started rising. October, November, kind of plateaued around $16, $17. And then it rose very sharply into that intraday peak of $49 in January of 1980. You can see on the right-hand side, silver started 1979 at $7 in the average price in the first quarter. It got up to $18 in the fourth quarter. For the year 1979, the average price was $11. In the first quarter, yes, on an intraday basis, the price spiked up to $49. On a quarterly average basis, the price was $32. And then you can see in April, or actually in March, the price of silver fell more than 50% in one day. And until April of 2020, when the oil price fell more than 50% in one day, we had never found another commodity in history that had lost half of its market value in one day. And the average price in 1980 was $20.77. Now that was enormous. I mean, the price of silver averaged $11 in 79. It was double that almost in 1980. And if you go back to 1978, the price was probably about $5 or $6 average price. So the price was 4 times higher than it had been on an annual average basis. And annual averages and quarterly averages, the ongoing price of a commodity, that's what matters to miners, and it matters to processors, smelters, and refiners. And it's what matters to fabricators, jewelers, and electronics companies, and mirror manufacturers, and everybody else that uses silver or whatever commodity you're looking at. And it also matters to longer-term investors. If you're a trader or a very short-term investor, which some people call speculators, you might try to catch that falling knife or the knife when it's been thrown up. But picking that peak is an extremely difficult thing to do. We've done it successfully a few times ourselves. A couple other people, Jim Sinclair and Gold, have done well on it too. But most investors content themselves to try to get it right on an annual average basis or a long-term average basis, because they're really looking at capital appreciation and capital preservation. So it's very important to understand, yes, the price spiked to $50 in January 1980, and it was there for at least a minute, and ended that day at $41, down 18% or so, and it averaged in the year $20. So that's the first time we saw $50 silver. Then you saw it in 2011, 2012. And again, saw the big spike up. Here we started in January 2011. The price was about $30, $34. And it started to rise. And you can see in the first quarter it averaged $32. You can see on the chart that in March, just before that April line, price was around $34, $36 an ounce. It went from $36 an ounce at the beginning of April to not quite $50 on an intraday basis at the end of April. And we said at the time, what was going on was the roll of the May COMEX contract. I'll show you some details about this in a minute. And that once the May roll was over at the end of April, the price would probably come down to $36. And as I said recently, I was wrong. It went to $32. Right? And again, yes, it got almost to $50 on an intraday spike for a minute, maybe several minutes back then. And then it came back down, and it came back down very sharply. The average price in the first quarter of 2011 was $32. The average price in the second quarter was $38, not $50, but $38. Very good price. For a fabricator, it was a disaster. For a miner, it was make it or break it, making it. And for investors who had bought at $5 or $10 or $20, it was a very good price. Price hung up around $38, $39 through the third quarter. This was a time of an international debt crisis, sovereign debt crisis. We were coming out of the Great Recession and the global financial crisis. The U.S. Treasuries was downgraded in the third quarter of 2011. And then it started to deflate in the fourth quarter. And in the fourth quarter, the average price was almost the same as it had been in the first quarter of 2011. And then the price came down a little bit further. I'll go back into this April and May of 2011 in a little bit more detail in a minute. But this is where we are now. So CPM Group is saying we expect to see record prices on an annual average basis at some point in 2024, 2026. And we've been saying that for several years, probably close to a decade now. And we still expect to see that. Our record prices that we're projecting are not $50 or higher. Our record prices are somewhat higher than the record prices of $35 that you saw in 2011. Higher than that, but not $50. Could the price spike back to $50? Of course it could. It's done it twice. Can it stay there? Not for a long period of time. The economics of physical silver, supply, fabrication demand, investment demand, inventories, do not support an ongoing price of $50, let alone $100 or $1,000 or anything else. So we are looking for higher prices in the long run. We're actually looking for a little bit of a spike up next week and then lower prices in May. But we want to be cautionary so that when people, hey, CPM Group's talking about a record price of silver, they don't think that we're talking about it going to $50 and staying there, let alone anything higher. So our expectation for the next week is that the price of gold and silver have been trading in a range for a couple weeks. The price rose sharply in January, November through January. The prices came off in February. Part of it was profit taking. Part of it was lower inflation expectations. Part of it was concerns about rising interest rates and the idea that we weren't in a recession already and that the world wasn't collapsing. In March, we had some bank problems, and the prices of gold and silver rose again. They've been kind of treading water over the last 2 or 3 weeks. Gold between, 1990 and 2025, 2030. Silver, I'm not even sure where it's been, $24, $25, $26. It did break above $26 briefly. Our view is that the prices will probably continue in that range over the next week. And in fact, today the prices are at the low ends of those ranges. We wouldn't be surprised to see in the last week of April, gold and silver move toward the high end of those ranges. And we issued some trade recommendations today for both gold and silver for shorter term investors, where we spell out all of the reasons for this. That's the last week of April. Into the first week of May, FOMC meeting, probably a 25 basis point increase in prices, probably a further reduction in inflation concerns and recession concerns. We think the prices of gold and silver could come off. So what we've been telling our clients who trade on a short-term basis, you probably don't want to necessarily go short today because you're at the low end of those ranges. But next week, you probably want to start thinking about going short. If you see the prices spike higher over the course of later next week, that would be probably a better time to sell. But if you don't see the prices spike higher, that also probably is a sign to sell. And it's probably a more bearish signal for gold and silver than if the prices do move to the high end of recent ranges next week. Let's take a closer look at this. These are the prices, daily high-low settlement of silver prices nearby active in April 2011 through May 6th. You can see the price started the month around $37, got up not quite to $50 at the end of April, and then it came back down to around $32 within the first week of May. Now, at the time, there was a tremendous amount of bullishness about silver. But CPM Group was saying, no. Take a look at what's happening in the silver market. This is a short-term phenomenon related to rolling the May contract forward. Investment demand is not driving the price higher, nor are other factors. This is the roll of the May contract. So we were telling our clients as the price rose, we expect it to rise into the end of April as that May contract's positions are rolled forward. In order to roll a contract forward, you buy back the May contract and then you sell a July or a September contract. So you just taking your short position or your long position and you're moving it down the road saying, okay, maybe I was wrong now, but I'm not going to capitalize my losses. I'm going to try to give myself another 2 months or 4 months to make it happen. And the act of buying back the nearby active can have, at times, not always, the effect of driving the price of silver up until the roll is behind you. This is what happened in April. And you can see the price, end of March, $37, end of April, $48.58, a week later, $35. May COMEX open interest. At the beginning of April, it was 367.5 million ounces of May contract open interest. And the guys who don't understand this stuff were saying, oh my God, there's no way that you can deliver that much metal into the May contract. But over the course of May, the people who were short those May contracts bought them back, pushing the price higher, and rolled their positions into July and September. So that by the time you got to April 29th, the first delivery day for the for the May contract, you were down to 7.6 million ounces. You had seen 360 million ounces of silver futures bought back over the course of April. And that's what drove the price higher. Silver ETFs rose a total of 2 million ounces, and coin premia actually declined over the course of March, suggesting that investors were not buying coins. What drove the price of silver higher in April of 2011 was the May roll. And I bring that up because as of yesterday, there were 300 million ounces of May contracts still open. First delivery date is next Friday for the May contract. And so between now and the end of next week, the shorts will be rolling those positions forward, buying back May and selling July or September. Nothing nefarious about this. This is the way all markets work. Nothing specific to silver, nothing nefarious. This is the way markets work. So we have 300 million ounces of May contracts as of this morning that will be rolled forward. And that could actually cause the silver price to be relatively strong next week. We think it could go back up toward 25.50, 20. Well, let me just see where it is now. It's 25.30. $25.50, $26. Could it spike even higher than that in the next week? Yes, it could. Will it stay there? Probably not, especially if the reason for any higher prices is the roll of the May contract out. And that's why we're telling our clients, okay, you might see the price move higher, gold and silver, next week. And that might be a good time, if you're a short-term investor, to reestablish short positions or buy puts. Because sell in May and go away applies to precious metals as well as to stocks. So that's what happened in 2011. You can see the May COMEX open interest at the beginning of April and at the end of April. And investors were not buying ETFs. And then after the price started to fall, they sold their ETFs. That's where we are. That's what I've got. We will be releasing our Silver Yearbook on May 16th. You can plug into the free briefing that we will be having. You can register for it on our website, www.cpmgroup.com. You may pre-order the Silver Yearbook and get it as an ebook when it gets released. It's a really good book. Got a lot of data in it, a lot of accurate data. And again, as we said on David Lynn's program this week, we actually are paid to get our market analysis right, not to be bullish or not to be bearish. And our statistics support a pretty good track record in calling the markets. We'll be coming out with our Platinum Yearbook in the middle of July. You can buy our Gold Yearbook, which we released at the end of March. It's already available for purchase and downloading on our website. I will be appearing in 2 different presentations next Saturday at Rick Rule's Electric and Battery Metals Boot Camp. I'm sorry, I've got a typo there. It's not a book camp, it's a boot camp. I'll be talking about the possibilities for, first off, energy metals and the idea that the energy transition faces a lot of headwinds that are not going to affect negatively the use of silver in solar power panels, but will slow down the transition to electric vehicles, as well as slow down the wind power developments, and what that means for the metals that are used in electric vehicles and windmills. I'm also giving a second talk about high purity manganese, which is used in electric vehicle lithium-ion batteries. And during the boot camp, there will be a place where I will be answering questions that people can type into the website. It's a $99 registration fee. It is definitely worth the $99 because it's not just me, it's a whole range of people who have been looking at these markets. And that's the link where you can register for Rick Rule's Electric and Battery Metals Boot Camp. My apologies for the typos. As always, you can go to our website, you can download, you can buy our yearbooks, pre-order our silver yearbook, buy our existing gold yearbook, and you can see various free reads, videos, presentations we've made in the past, and read all about CPM Group. And the fact that we are a research and consulting company that is paid to get our analysis right, not to be bullish, not to be bearish. Thank you. Take care of yourself and those around you. I guess Earth Day is tomorrow. I remember the first one, and pretty much everyone ever since then. So think about what you could do for the world, because it needs help. Take care.